Welcome everyone to another Robinland podcast, and today we have another very special event where we discuss real-world assets on-chain and the tokenization of real estate. Joining us today is our very own CEO Scarlett Chen, and alongside her we have Mel, the co-founder of Petra Labs, John, the co-founder of Balcony DAO, and Andrew, the founder of Honeybricks. If you'd like to join us live on one of these events, be sure to follow us on Twitter at RobinlandIO. We had a lot of great discussions during this event, so sit back and enjoy the show.
So thanks everyone for coming today. This is, I really appreciate this opportunity. Just having the three of us here, talking about real asset on chain, tokenization of real estate in general, and the different approaches, we're taking around this. So I'm Scarlett, CEO of Robinland, and what I want to do first is just let everyone talk about themselves, because usually we just focus a lot on the company that we're building, but I believe the people is the key. Like, what led us here? Why do we believe in what we believe in? Why are we building what we're building? So John and Mel, why don't you introduce yourself and what led you to here today?
All right, I guess I'll take that. So I'm John Blitzky. I'm a co-founder at Balcony DAO. We are fractionalizing real-world real estate on-chain in the form of NFTs. And to accomplish this, we're building our own RE NFT protocol, which is a NFT protocol that allows us to bring absolutely all of the metadata associated with real estate on-chain. So that means income, expenses, air rights, encumbrances, everything that you could think of, rent payments, defaults, construction permits, sign-offs, draws, everything. Everything goes on chain. And our goal is to create a radical kind of transparency that allows investors to invest in this asset class with confidence. And importantly, what we're doing is opening up access to this asset class, which has typically been very difficult to access and invest in, by allowing people to invest via Reg CF offerings, Reg A offerings, Reg D offerings, and using all of the available totally regulated and compliant paths to purchase so that everyday ordinary people can make acquisitions in this space. And so I got involved in real estate as a teenager. I started off in the Bronx, have been licensed in New York City, or New York State actually, since 1999, but have been doing deals really my whole life. I own a real estate investment banking firm, commercial brokerage, and an M&A firm, and have been sort of through every single vertical of the space, from owning a design build firm, a national maintenance company, forming capital, structuring it, and doing deals really my whole life. And to me, it seems obvious that the next step, the next evolution in this space, is that we adopt the technologies that are available to us to create this transparency, which in turn creates this liquidity and access. And that is the message and the intent of Balcony DAO.
That's amazing. That just reminds me of, real estate has been one of the industry that's been around for basically forever, as long as, as far as human races are here, buildings are here. But this also means real estate is one of the industry that has not really embraced innovation. And when I heard you saying, using NFT to solve a lot of the problems, I was like, this is exactly kind of thing that we needed. And speaking of technology, I know that Petra also has a very innovative way using blockchain as a technology to solve some of the problems. So Mel, why don't you talk about that? And would love to hear, what led you here.
Yeah, absolutely. Thanks. So I actually joined this industry back in 2018. I ended up joining real estate actually in back in 2015 when my companies exited and I wanted to figure something to do. So real estate just kind of seemed like the most logical answer, and that's kind of where I ventured in. And I've had about $100 million in residential sales since about 2015 here in Southern California, and I've always been kind of fascinated with crypto on the side. And to your point, I've been kind of waiting around for quite a long time, just trying to see if there was any sort of projects kind of coming on board in the real estate space. And as we were talking about earlier, there's definitely a lack of real estate representation. And last year we started kind of developing in the early stages of the model. And I think what's kind of fascinated me the most was, are you able to build a model that's as legally compliant as you could possibly get it within the space, but also allows as many investors in without any sort of accreditation. So a fully public model that allows anyone in the world to actually invest or actually buy a small slice of, for as little as $1 within the space. And what we've actually came up with was, using and recycling a proof of transfer mining mechanism on stacks and using a mining classification on there. And that was kind of like our workaround. And what we're actually building is a affordable housing project that, as John kind of mentioned earlier, kind of splits apartments into a rent to own model where people can actually start owning units in a rent to own model within their apartment.
That's great. So just as we were speaking, I realized Andrew actually is here. So thanks so much for sparing time that you're able to join. So Andy, why don't you also speak about what Honey Bricks is about and what's your journey until here?
For sure, and thanks for the introduction. So everybody, my name is Andy. I was born in Australia, as you can probably tell by the accent. I immigrated to the US in 2015. I probably first got involved in Bitcoin and ETH probably around 2015 and really started going into the tech scene. And on the real estate side, my dad was actually an architect and got me involved in real estate at a very young age. It took me to building sites, taught me how wonderful and important real estate really is. Wonderful in a sense that it's where people live, work, and play, and important in that it affects everyone's quality of life, and it's around us every day. He helped me buy my first apartment. I've been consistently investing since then, and I've seen the power of real estate as a platform for wealth. The stability, the diversification, the cash flow, it really is a great asset class. And then things on the crypto and real estate side really came together for me in 2020 during DeFi summer, and watching all these new protocols like Compound and other ones spin up and just bring that liquidity, like low friction and access. And I think that's when the light bulb switched for me, was that how can we give more people low friction access to this great asset class of real estate with all these incredible new technologies being built. And then we really just assembled the team in early 2022 and have got started really laser focused on that problem. What makes us unique is that we really partner with existing operators to raise and manage their capital. So rather than going out and trying to do our own real estate, we're really seeking to partner with the best real estate companies out there to help them leverage the power of tokenization and DeFi.
That's amazing. We can already see us all coming from different approaches. So a bit about us, myself and Robinland. So I was a PhD in economics at Stanford, where I studied housing and real estate. So it's not because Stanford, econ program is good at housing, which it is, but to me, a piece of a house has always been a really fascinating asset because it's a combination of two things. It's investment, but also consumption. And because of this, there's just a lot of inefficiency around it, because you can imagine there might be families who just want to own a home, but their demand is being crowded out by, speculators, right? Like bidding wars that we've all been suffering through over the past few years. But on the other hand, for people who want to invest, this is a really good asset class. There's people who said, if you don't have a house, this is the first thing you should buy, but it's just very lump sum, very hard to access. So what my dissertation was about was basically how can I use financial innovation to decouple these two, say create a derivative that represent the house price but not the underlying consumption, so that people who want to invest can hold on to this small piece, very liquid assets, and leaving owner occupants alone. And people who want to live in a house can even buy a house and hedge out the risk by shorting this asset. So that idea really fascinated me, and I wanted to bring it to reality. So I didn't go into academia; I went into industry. So I was a data scientist at Google, where I was working on ads. But on the other hand, I actually came across Google's internal crypto group and realized that, hey, crypto is the missing piece of the puzzle, because it is a specific realization of the quote unquote derivative I was chasing after, I was looking for. So why don't I try to bridge the two? And at the same time, I was lucky enough to have met my co-founders. So Venus, for example, have actually worked in real estate for 7 years. So even though I studied real estate, I didn't really work in it. So it's like two very different stories. And she was able to bring in the operational, legal, financing, capital market side, expertise, and also, connections and resources, which is why we now have in our hand term sheets for a extremely high quality asset in, Brooklyn in New York, which is a multifamily construction loan, which me myself, if I can, I would invest in. But we are reserving this quota for our audiences, in August when we first launched the product. And on the other hand, I also came across our CTO as a co-founder who works at Google for 6 years, has also issued his own token before, so very crypto native. So I think, kind of as Andrew mentioned, we're also different. I think what sets us apart is we do have in our team people on both sides, like people who are very crypto native and people who are extremely real estate native, because we think you need perspective from both sides to complete the puzzle. And we're coming from a angle or direction of trying to level the playing field for people, because there are very high quality but very large size real estate that are really good investment products. Those Blackstone, BlackRock type usually invest in, but it's simply too large for a retail investor to access. And that is something that I don't like, which is in TradFi in Web2, things are very monopolized by large institutions. And what we want to do is to use blockchain technology, use smart contract to level the playing field. We want to tokenize them so that each piece is like $5, $10, or $100, just like Andrew and Mel has said. And then anyone, hopefully at some point, can invest in it. And what we bring in also is the debt side of things. So a lot of us are working from the equity side, essentially owning a piece of a house, either commercial or residential, and sharing the rental revenue or rental income with people. But we believe that people need fixed income product just as much as equity product. So we're actually, extending loans to developers who can build a building to solve the construction or, housing crisis in the U.S. because we're always short of houses. So on the other hand, we're offering these products as fixed income products in very small size to retail investors. So if you're, by any chance interested, feel free to come up to our website, robinland.io, and then put in, your email for early access. So this is hopefully the only time that I'll do, this kind of advertisement for us. But shifting gears, now that we're all here, let's talk about, why real estate or real asset and blockchain together. Like, well, on the one hand, what kind of benefits can blockchain bring to real estate? As John has kind of mentioned, NFT is a form that we can use to standardize things, can represent all different metrics. But what are some of the other uses of, say, blockchain in real estate? Why do we need that? Why not just fractionize it? What's new about it that allows us to do now that we couldn't in the past?
Yeah, I'm happy to touch on that first. I think the most fascinating concept for me is just the sheer amount of liquidity and the amount of participants that we're seeing getting onboarded into this space. And I think we can all agree that DeFi will likely be the future financial infrastructure of the world. And you can't really do that without real estate itself. You need to have a true kind of store of value other than, just a flat out kind of stable coin, which you see right now where anytime there's any sort of downturn, everybody kind of floods and kind of flees over to stable coins. And I see a future where instead of everybody fleeing in stables, they're going to be fleeing to more real world assets down the line. And I think what I'm really kind of fascinated by is just the amount of fractionalization that you kind of said as well, but also the capability to kind of audit in a much more streamlined fashion. You don't really have to go through a bunch of disclosures and a bunch of nonsense. Instead, you can have everything kind of audited on chain. And I think that those are the two main components that I kind of foresee in the space where it acts as a store of value instead of a stable coin. But at the same time, you can actually audit these underlying projects and kind of see exactly what's going on. And that's kind of like my long-term thesis of where this space could go.
Yeah, I'll jump in on that and think just riffing on those two ideas. One on the stability thing. I was just looking at coin market caps. So roughly half of the top 10 biggest coins out there are US dollar stable coins. I think there has been a huge flight to stability. I think coupling into that, it's really around education. I think we all have a huge road ahead of us, educating the mass market about DeFi and steering clear of that perception of fraud, risk, volatility, scaring people away. Because I think until we get that perception, mainstream, that there's trust, there's transparency, there's verifiability on chain. I think that's the biggest opportunity we have. So I think really around the stability and just a mode of education, bringing real world assets into a really trustless manner is something I'm really looking forward to.
Yeah, I mean, I don't even know where to start because there's just so many benefits. I mean, firstly, we have a sort of ethnocentric view as Americans, but if you see what's happening in the rest of the world with brush fires in sub-Saharan Africa, South Asia, what's happening in Europe, even, God forbid, who would have ever thought that we'd see war in Europe in 2022? A lot of the middle class in these countries are going to start exiting their local currency. They're going to divest themselves from local assets. And typically those people flee to the United States. And I think that being able to tokenize these assets is actually creating a store of wealth for people even outside of the United States that often get overlooked in these conversations. But then we have the transparency that's not just the transparency of the asset, which we'll get to in a second, but how's about the transparency of the sponsor, right? All these sponsors on Twitter who are raising capital here, probably illegally, tell you about all of their home runs, but they never tell you about when they struck out. So being able to audit sponsors is another benefit of bringing these assets on chain and being able to tokenize them. Then we have the completely new trading vectors that we see when we have these data that are now online. Like, for example, you might find out that a given property has had a 150% increase in electrical usage over the past 6 months. You can infer from that perhaps that tenant is going to move out. If it's an industrial property, they may expand to the vacant space next door. This data can be brought on chain. You could find out when they file their construction permits. You could say, well, this is an alt too. They're going to spend significant amount of capital on this. This CapEx is going to increase the value of this asset. I'd like to invest now. There's just so much more data. There's so much more richness to the asset class when you can actually see what's happening with it. And it transforms a opaque and typically illiquid asset into a much more liquid asset. Then you have the trust factor, where if you know that you don't have to trust your sponsor implicitly and just hope that whatever he does in his black box works out for you and then he just sends you your dividend, you now can have sponsors that you don't know, right? And that's really important to people like me who grew up poor, because that means that poor people don't need to be implicitly trusted by their LPs. You don't have to have a country club membership to raise $5 million anymore. So that means different types of people are going to be raising capital, and they're going to be building different types of assets with different ownership structures, which means that the built world that Andy was discussing is going to change because the people who are making these decisions is going to change. And those outcomes are very exciting to us. And that's just the tip of the iceberg. I mean, I could talk about this for 6 hours.
Yeah, absolutely. I totally agree with this because one of the reasons why I study real estate is that it's so opaque and it's just very non-transparent. So say, for example, me personally, I'm trying to buy a house right now in California, and then we really should have just run an open auction, say, for example, on chain, but rather we have a layer of intermediary, which are essentially agents between us. So, one time I placed an offer and the agent is like, there were another offer, but that's much more above use. And then we eventually decided to, not pursue. And then turns out the house wasn't sold. And now that we think about it, there probably wasn't another offer. But, in 2022, in a market economy like the US, things like these can happen because things are not, open and transparent on chain. And speaking of, debt or fixed income, it's the same. So if you put your money in a fund or ETF, debt funds, you have, again, a layer of manager between you and the assets, and you will receive some kind of K1 at the end of the day, sure, but still you don't really have control over how you want to allocate. But in our case, as long as developer pays us, you will get paid because all of the transactions you'll be able to see on open ledger. So your share is recorded in a place where everyone else can see. It's decentralized, and the token that represents your ownership is also stored in your wallet, not somewhere in an Excel spreadsheet in our computer that can be lost. So this whole technology, blockchain or smart contract, just changes the entire game at a very fundamental, deep level. So this is why we are so excited about it. But on the other hand, the really funny, interesting thing is, being the real asset on chain space, you talk to both sides. Sometimes you talk to real estate people; they're all very excited and trying to embrace blockchain. But on the other side, we have the crypto people, and sometimes when we talk to them, they're like, why should we apply blockchain technology to something that is not built for? Because people are afraid and scared of anything that's off chain. Because as long as we are on chain, things are trustless, right? Because this is a piece of code. As long as there's no bug in the code, I know things are going to be executed according to how it's written. But then as long as there is an element that's off chain, I don't know, right? You said this piece of asset is worth 1.5 million. I don't know whether I can trust you. So this is the kind of attitudes that I sometimes run into when I talk to crypto people in the past, 1 to 2 to 3 to 5 years. So one thing that I always wanted to talk about with people is, what do we think real asset or real estate can add to crypto or DeFi in general, that wasn't available before? Because I truly believe that there is something there that we can bring in. So this is something that I would really love to hear your opinions on. Like, what are we bringing into the whole Web3 environment that wasn't there before?
I can jump in on that one because I know a problem we're working with at the moment. One thing which in a traditional real estate market where investments are syndicated, which means there's many investors pulling their capital to write a bigger check into generally a higher quality or a bigger asset, they really struggle with secondary market liquidity. And the reason for that is it's just a nightmare managing who's it go to, what are they paying for, are they compliant, is it accredited, how do we manage the transaction, who's doing the wire. There's 50 steps to get it done. And because of that, these things trade at a significant discount when they do trade. Now, when we think about DeFi and smart contracts and crypto and the underlying technology of the blockchain, that's one of the principal problems which it solves really well, because all of that can be coded out in the smart contract around if this, then that statements that's publicly available on the ledger. And if two parties want to transact, that can be done all trustlessly on chain without the involvement of any intermediaries, brokers, or people clipping the ticket along the way. So I think when we look at syndications and the secondary market around those investments for smaller investors, we see that's something which blockchain and DeFi can really revolutionize in that space.
Yeah, I actually completely second that. I think the most interesting part there is the liquidity component. I think real estate projects will still struggle with that a little bit, just like any other project will, where you want to always kind of figure out where that liquidity will come from. And there's a off-chain illiquid asset versus on-chain that could be pretty liquid. And I think it'll be really interesting just kind of tracking the projects in the space, especially in the real world asset space, and seeing how are they tracking any off-chain prices, but also that on-chain liquidity, and just kind of seeing the solutions there. We're testing out like a game theoretic way of maintaining liquidity where only the top 4,000 wallets, for example, would actually maintain and actually earn the rebates or the yields. And it kind of creates like this competition element that requires everyone to actually add to the liquidity versus slowly strip it away. So I think that's one thing that I'm super interested in kind of seeing is how will projects over time solve that liquidity, chicken and egg problem, so to speak. And I think the second thing that I'm really interested in and always have been kind of fascinated by is just communal ownership. You see something like Links DAO where they're buying a golf course, for example, and I think you're going to start seeing a lot of that kind of come on board as well, where communities are rallying together to buy an asset to share communally in a way, and it almost acts as like a communal timeshare in a way too. So those two things I think I'm the most fascinated by as far as solutions in the space.
Yeah, I'm obviously I echo your sentiment. I mean, we're in the same space and we're looking at it the same way. The secondary market liquidity is massive. Typically when you own an LP stake in these assets, it's effectively encumbered because who the hell are you going to sell it to? You have to go find a buyer for an LP position with a sponsor that they don't know, with really no data to support what you're doing, save for potentially, just the financials that are generated on the asset, which don't tell the full story. And so being able to illuminate really the value of these investments and create a liquid secondary market is huge. And when I say a liquid secondary market, I want to put a giant asterisk next to that. We're dealing with this by degrees. We're not taking a real estate asset, and we're saying, oh, because we put it on the blockchain, now it's going to trade with the same liquidity as Tesla shares. It's going to trade with orders of magnitude more liquidity than a private LP syndicated investment. And that's our bar, right? Like our metric isn't, are we Tesla? Our metric is how much better than the existing structure are we? And I think all of us are going to be far more liquid than our counterparts who are not on chain. And that alone is worth the squeeze, right? That's the sieve that gets developers to actually contribute this data and make it available. The prize is you really will have much more liquidity than if you otherwise didn't. And that's a powerful economic incentive that I think will also translate to lower cap rates for assets that are completely transparent versus assets that are opaque.
That's actually fascinating. I've actually never thought about it that way. I appreciate that insight where it's actually comparing the bar to the former versus the latter of, it's not going to have the same liquidity as something as like USDC, but it will have a far higher degree of liquidity compared to the traditional version. So yeah, that's actually a fascinating comparison.
I think this is really interesting. Speaking of liquidity, this really reminds me of the whole USD thing. So at some point in the past, we were planning to launch a protocol ourselves, which involves some layer of stablecoin. So at that time, everyone's asking us, this USD thing happened. So how are you going to try not to beat that, or try not to be the second of USD? And what I was saying is, what happened in the UST Terra Luna event is you're trying to back $18 billion of a stablecoin with $20 billion of assets that's on chain, that's Luna. It looks like it's fully collateralized. But the question really is, what's the replacement value of that collateral when you're trying to sell the whole position? So when you're trying to sell the $20 billion of Luna completely, as you sell, the price goes to zero, right? And then you can get back at most maybe 5 billion. So that's really the value of the stablecoin you're backing. And the problem is, the fundamental reason is, you're trying to liquidate a full position. But imagine now you're backing that $18 billion of stablecoin with $20 billion of real estate. And what happens when you're trying to sell that real estate? The price is not going to change because we have $3 to $5 trillion of transaction volume for real estate every year. Real estate is huge compared to crypto. So, crypto is like this new, hot, really sexy thing that everyone feels is a very large field. But honestly, the total market cap is like 2 to 3 trillion. That might have dropped to like 1 to 2 trillion over the past few months. But, compared to traditional finance, it's still pretty small. So, as I kind of mentioned, real estate itself is going to dwarf that. So if you're backing a small thing with a big thing, that's much easier than the other way around. So that's why sometimes liquidity might not be the best thing if you think about, really, value creation. A lot of people are talking about real estate being bad because it's very illiquid, but it's also its benefit to some extent because it means there's slightly less transaction and less volatile and less speculative. So it's much easier to price, and okay, this $2 million piece of land is most likely going to be 2 million tomorrow instead of zero, like what we see for a lot of crypto assets. And that's why we are seeing a lot of the more quote unquote crypto native protocols are actually now seeking out for real asset or real estate to back their treasury. So when I was at NFT NYC, I was talking with people, be like, do you know Maker is actually trying to use some of the real assets to back their treasury? They're like shocked. They're like, how is it possible? We thought, real asset on chain is something that's going to happen 5 or 10 years down the road. And I'm like, no, it's already here. It's already been happening. So part of the reason why I started, Robinland, or believe that this is going to be a thing, was last year, around June-ish, I got to know someone at Maker that's, relatively one of their very early founding members. And I learned that they're actually trying very hard to use off-chain assets to back their treasury. And I was like, why would that be the case? And it turns out if you're trying to create a stablecoin, which is DAI, with over-collateralization using ETH, and ETH is something that changes its value potentially 50% daily. Like it wasn't the case during a bull run. During a bull run, everything is perfect. Like nothing breaks. But the key is the black swan event, the tail event, like what we're seeing in the past few months, like what if that happens, right? So in order to insure against this kind of tail event, you would need an extremely high over collateralization rate in normal time. But then this limits the ability of maker to expand DAI at faster speed because you need more asset to back the same amount of dollar, which is DAI. So that's why they're like, let's actually seek for things that are less liquid, that are more stable in value. And real estate is almost, the very natural next step. And that's why we're like, wow, this is actually really happening. Because in the past, when I look at, real asset on chain, most of the things that are missing is demand. But now actually it's pulling from both sides. More and more crypto native protocols are realizing the value of real estate or real asset, whether it's more stable in value or it's larger in size or it's just a better type of asset backing treasury. And on the other hand, real estate is also trying to embrace crypto more and more, either using crypto as a form of payments or using blockchain technology as a form of transaction, so on and so forth. So there's really demand from both sides pulling from us. And the theme is really forming. And that's why, today we're all here and there are just so many different approaches trying to address issues in this field. I'm trying to bridge these two worlds together. So on that, I kind of want to talk about what's the status of, real asset on chain today. So we kind of talked about in the past, why do we need blockchain for real estate? And on the other hand, why do we need real estate for blockchain? And now that we're here, we have finally understood and realized that these two need each other. What kind of methods and solutions have we seen? What are the different approaches? For example, our Theopetra is very different from Balcony, from Honeybricks, from us. Have we seen other very interesting, innovative ways to address this, protocols, solutions, or even questions? Or we can also just dive deeper into why did you choose to approach this question your way?
Yeah, I mean, our approach at Balcony is to create a layer zero asset, which is what real estate is, right? To your point, we don't need stables. Stables need us. Stables need something stable to actually back against. The New York City real estate market by itself is $2.8 trillion in market cap. So we effectively dwarf crypto at the moment just in New York City. It's a $326 trillion global asset class. And so as a base zero investment, we can then service the secondary market, which is the liquidity, but then what we describe as the tertiary market, which is the DeFi protocols, right? That's your stable coins, that's your lending protocols, your staking protocols, and so forth, that can then live on top of that base layer. And so our perspective is that the reasoned, sort of conservative way to approach this that pays deference to this industry and pays deference to both real estate and the crypto spaces is to create a pure vanilla direct investment into capital assets that are core assets, that are strong and stable, and allow these other products to build on top of us in this way that DeFi has taught us about Legos, right? They can snap into these assets. They could use that to stake. They could use that to yield. They can put it in their treasury and they could buttress their token price so that they have a concrete floor so you don't see these DAOs getting decimated. These coins that hold real estate in their treasury will then have a value that is irrefutable, right? It protects them against short squeezes because at some point you're going to bump up against the real estate, that base zero layer of asset, and you're not going to get short squeezed past the intrinsic value of the real estate held in that asset. And so we view priority one as doing that correctly, doing that honestly, and doing that directly.
Yeah, I actually completely agree with that thesis. I think it's going to start coming just from a flat out need. And I think this last bear market is absolutely exposing that need where DAOs and protocols will start approaching much more pragmatic ways and solutions instead of just partnering with other projects that are a lot more volatile. So that's kind of in line with our thesis as well, where letting other DAOs and letting other projects just kind of build on top of us and actually hold it as a treasury asset, so to speak. And long term, the thesis is that even individuals will start kind of coming in a lot more as a uncorrelated asset source and uncorrelated yield source, where it's not really dependent on the crypto markets themselves. So I actually completely agree with that thesis, where it's going to just end up going first to individuals who want a diversified asset, but also then a lot larger is going to be DAOs and protocols that have no other choice. They're going to have to diversify. Otherwise, we're going to keep going through this nonsense of up down, without much progress really being made on the price itself.
One thing that has been mentioned, which we think a lot about, is just the regulatory roadmap and also the consumer adoption curve. In the regulatory environment, obviously, there's still discussion around, other securities, other utility tokens, whatever they may be. And I think when we're dealing with real estate, there's fairly clear understanding these are securities, which means that they come under SEC or exemptions or those sorts of things. So it's really creating a legally compliant and low friction way to give people access to the great asset class. And secondly, when I think about the consumer adoption curve, there was in 2018, there was I think the first case of this where there was an Aspen ski lodge put on chain, but no one had wallets to really own these tokens. I think what we've seen over the last 3 or 4 years is 70 million EVM compatible wallets have come on chain. We've seen the development of layer twos on and off ramps. So I think the wealth of innovation and education around holding tokenized assets or putting real world assets on chain. I think that the more we can bring the community here and deepen that market, the more innovation and people that actually can invest this way or hold assets this way is going to keep growing.
Yeah, totally. So kind of the approach that angle we're coming in is trying to create the first crypto bond on chain and providing a sustainable yield. So the really funny thing is 3 months ago when I talked to crypto people, they're not interested at all. They're like, why would I put my USDC into something that's giving me 2 to 8% if I can get 300% anywhere in crypto right now? And it's true. I can't really fight that because that's what they're seeing and what they've seen in the past 2 years. But all of that changed over the past few months. And actually, a lot of those people are coming back to me to ask, how can I actually put my USDC in your product? So I'm really seeing this sort of change in mindset, people realizing sort of the rule of gravity as we were talking about at the very beginning. And historically speaking, crypto is attracting the people who are more risk loving, which is very normal. When there's a new field, the people who are going into it are usually the more risk loving ones. So that's why what's available in crypto usually are what I call crypto equity or crypto stock, things with extremely big upside, but can also potentially go to zero. So like extremely risky. And on the other hand, there's the stable coin, which doesn't bear any yield, which I call crypto cash or crypto currency. But there's nothing in between. There's not really a crypto bond product out there that gives you a fixed passive income for a 8 to 10% or not 300%, but something that's reasonable. And that's something that's missing that I believe real estate can provide, because that's the nature of this asset class that we're dealing with. And this is also its strength compared to a lot of its counterparts that's already available within crypto. So that's what we are essentially trying to offer, especially during this bear market. Like you will need to park your stable coin somewhere, right? You're probably not going to off-ramp it completely, because for a lot of people, that's very high cost, for various reasons, tax, legal, whatnot. So they want to find within crypto a place to park their cash for a period of time until the next bull run comes along. And we hope that we can fulfill that need for either retail or institutional investors. And then people ask, what if what happens when there is a bull run? People are gonna pull out of a product, which I actually don't believe so, because as crypto becomes bigger and more mainstream, mechanically speaking, the average or median person within crypto is closer to the median person of our general population, which is not a degen, which is not an extremely risk-loving person, probably a normal investor who typically has what's called portfolio diversification or some kind of allocation across different asset classes. So as crypto grows larger and larger, there will be more and more demand for slightly safer assets. And real estate is, I believe, the first to offer that, because last time that I took a look at security token market, 80% of the asset is actually real estate. So real estate, for some reason, is the most advanced asset class in terms of taking itself on chain. Like we're actually more advanced than some of the counterparties like commodities or gold or whatnot. So we actually already have a foot in, in this field. So that's what I kind of wanted to mention, why we're taking this approach that we are, and what problem that we're trying to solve. So even though we're trying to solve a lot of problems, there are still a lot of challenges that remain. So even if we kind of pretend that things are all good, there for real asset on chain or tokenization of real estate, there are still a lot of challenges that we are all jointly trying to tackle. Either it's operational wise, or legal wise, or financing wise, or investment wise. So that's kind of what I wanted to just ask everyone, like, what are some of the challenges that you have run into on this journey, and what are some of the challenges that our field, real asset on chain in general, should solve or have to solve before we become more mainstream.
Yeah, I mean, for us, the first challenge is where do you start? And we were lucky because we have about $2 billion worth of assets that we control that we're bringing on chain. So we didn't have to go make these pitches to individual developers and get their heads around it. And so that was sort of the first hurdle that we overcame. But then there's the regulatory environment, right? And to Andy's point, you look at this and you immediately say, okay, this is a security. Now it's a question of how do you offer this security to as many people as possible to fulfill that ethos of democratization to the asset class. And the SEC goes out of their way. I always say this: the SEC goes out of their way to protect the poor from wealth and make it as hard as possible for you to offer this to as many people as you can. And so you then have to start to find a way to build the most efficient rubric for individual slugs to participate against the total capital raised inside of all of these different regulatory frameworks, right? Then you have the problem of taxes, right? So one of our most important objectives was we need to preserve the tax advantages of this asset class. So we had to build it in a way that allows the consumer to get the benefit of depreciation, which is a huge reason why you invest in this asset class to begin with. And so, all of these things ended up bringing us down this road where we end up with effectively this LP structure, which is a sub DAO. Each building becomes a sub DAO that lives inside of the larger Balcony DAO, right? But when you purchase an asset, you're actually living inside of 123 Main Street DAO, inside of Balcony DAO, where you preserve those LP benefits from a tax perspective. You're regulatory compliant. We have the access that we think we want to achieve here, up to 2,000 odd investors per asset inside of that sub DAO. And gaming this whole thing out and figuring it out, it took a while to figure out the regulatory path, and it took a lot of money. Frankly, the SEC also does a good job of making it expensive to offer securities. And so, you have to pay the freight to do this correctly as well, which is another challenge, right? So then you have the capital raise that you have to accomplish to actually build the infrastructure to actually offer these securities in a regulatory compliant way that preserves people's tax advantages. Then you have the problem of, well, you need a secondary, right? So you can just go and bolt onto a secondary and just pay into a secondary market for that ATS to get that liquidity. But we didn't want to do that. And so we're developing a regulatory compliant secondary as well with partners so that we can control that process, keep all of that data consistent from cradle to grave, and service that customer. Then you have the problem of, okay, so we did all this, but we know we're a base zero layer that other DeFi products are going to want to build on, right? So now you have to build the compatibility and interoperability with all of these other layers in the DeFi space so that you can actually create the loans and the staking liquidity that these people are going to want at some point, right? So it just goes on and on and on. Like the problems don't stop. They're all surmountable, but they all require that you're constantly interrogating this model and trying to figure out, did I just do something that encumbered this asset? Did I just do something that diminished yields? Did I just do something that precluded these investors from accessing the tax benefits of this asset and effectively eviscerated half the reason why people go into this asset class? All of these things end up getting stacked up together until you arrive at your product. So, for us, it was a long road. I don't know about you guys. I don't know if this was something that snapped together quickly for you, but these were intense conversations, intense research and exploration, a lot of money, and a lot of time for us over the past, year to put this thing together in a way that we feel is actually ready for consumption.
Yeah, totally. Oh, Mel, I saw that Mel unmuted. You go first.
Sounds good. Yeah, no, I definitely agree with John. It's absolutely a combination of legal and technical challenges, and I would say it's absolutely more of a legal challenge more than anything, especially for us. You know, we're approaching a vastly different approach, I think, from a lot of real estate projects, just in the sense of public participation. And you know, one thing that we've been absolutely fascinated by was specifically the Stacks ecosystem, where they have something that's called proof of transfer, and they were one of the first projects that actually went through SEC clarification, and it's actually classified as a mining activity. So we actually found that as a very kind of elegant solution for us, and starting with that first and kind of working backwards, you know, working from another chain, working backwards into Ethereum. You know, there's a combination of legal challenges, but also technical ones as well. So absolutely, to John's point, there's a lot of things that need to be overcome, and I think there's going to be a lot of interesting kind of innovation around this space in general. But I would say it's first and foremost, I think, more of a legal challenge more than anything. I think building within this space.
The tech too, though, you know, I think that the plumbing in the space is inadequate, frankly. You know, the current blockchain architecture doesn't really favor real world assets in my view. So we've built our own subnet because we're just dissatisfied with what was available to us. And then moving into, you know, the ERC 721 standard for the NFT, completely dissatisfied, not enough metadata. You can't really bring the quantum of metadata that we want on chain with that. So we built our own RENFT just to accomplish that, and we were able to build all this pretty quickly because thankfully we recognized these shortcomings early. Which, by the way, anybody can build on the RENFT technology. It's not some like, you know, gated access thing. Anybody can use that if they decide that they want to do a real world real estate project and want to tokenize it as an NFT and fractionalize it. And frankly, we recommend you do because it favors this asset class.
I would just round it out as far as the challenges that we will overcome. I think definitely regulation security is number one, and I think John and Mel answer that point really well. Secondly, is actually understanding all the crypto infrastructure. I think a very small portion of the world really understands how this stuff works and is put together. Not that end users need to understand it. Obviously, they just want a great, you know, customer experience or investor experience. But probably the third one, which often goes unsaid, especially when we're dealing with real world assets, they need to be good real world assets, or at least adequately described. And I think that's often a forgotten point because, you know, putting poor quality assets, which may be misrepresented or anything like that, on chain isn't going to help the community or help build a really strong brand name around what we're doing. So I think the third piece is just making sure that you really understand the real assets that are coming on chain, and then investors or users in the community are aware of exactly what they are.
Yeah, I totally agree on that. I think this is a really good point, which is not all real assets are the best to bring on chain because what I kind of mentioned, you know, what real asset can bring to crypto is sort of stability, you know, something with real value. But not everything is like that. There are a lot of, say, borrowing and lending that's completely uncollateralized, and for, you know, for the large part, probably the borrower won't repay. Then if we bring that, then, you know, default is still going to happen. Like, it's not just the case that as long as it's off chain, it has less default probability. So what we did was we wanted to be one of the best, you know, essentially asset supplier into this field. So we actually spent a lot of time trying to pick out absolutely the best developer, people with a, you know, best track record, asset that are extremely safe, very, very low loan to value. So like the first project that we're going to onboard is a start project, and as a result, it's going to be smaller in size. So there's always this trade-off of, do you want to expand faster, just, you know, onboard anything that comes to your forum, you know, submit a proposal, or do you want to be more hands-on? So one of the challenges that we actually faced was decentralization versus centralization, because crypto people would, you know, always love to hear the word decentralization, and what they don't like about real asset is it sounds very centralized. So we see a lot of model out there that has already been around for a few years, where it's basically permissionless. Like anyone can apply to be a pool manager or asset supplier, bring anything, and then people are going to buy these tokens to represent them. But what we are facing is a long bear market going forward, not just in the crypto space, but in general. Liquidity is drying up. I personally expect to see a lot of default going forward in the next few years. So that's the time where we would be able to tell the difference between high quality versus poor quality, which might not be that salient in the past few years, where there's enough liquidity from the Fed and all asset prices were high. So to us, that's why we took the approach of being a bit more hands-on at the beginning. That might appear to be more centralized, but really what we want to make sure is that investors who put money in will not lose that, and we want to make sure, even if everything else defaults, we're the one that still survives. So on that, I know we only have 7 minutes left. I want to open up the floor to anyone who want to ask a question or just talk about something related, or chime in, or challenge us, right? Because we're all here very openly trying to just talk about this field in general. So anyone who wants to, chime in, please do go ahead.
While we're waiting, Scarlett, I have a question for you. You guys are focusing primarily on multifamily. I know your first deal in Brooklyn is a residential piece, but recently we're seeing in the capital markets that office buildings, for example, are getting no bid on refi, some of them, which I think speaks to even the large institutional lenders taking a look at the space, looking at tectonic plates moving around and saying, we're going to pull back. We're not going to go chase certain sub asset classes, and in particular, certain specific assets that we think are going to be challenged. What is your sort of macro view? Is Robinland going to stay entirely in the lane of multifamily, or are you guys going to venture off into other sub asset classes?
So we do plan to venture into other asset classes. We started with a multifamily construction loan project in Brooklyn, mostly because of the fact that we are in this network and we understand this asset class really well. So Venus, for example, our CEO, has worked in New York in real estate, and specifically with crowd funds, which is the partner that we're going to work with, forming a JV, jointly investing in projects, jointly underwriting, and they are very, very plugged into this industry. So like it or not, real estate is an industry where relationship is important, network is important, and things are very heterogeneous. So there's no one thing called real estate, but there's commercial, there's residential. Even in commercial, when people say commercial, they can mean a lot of different things. Like a hotel is very different from parking garage, different from shopping malls, different from mixed use, different from, say, multifamily construction. So that's why you want to make sure that you have industry experience in the specific vertical that you're working on, and you have the ability, the human capital, to tell the difference between a good and bad one. So that's why we're taking the approach of being more cautious, making sure that we pick a project that we understand really well. So that's why for the first one, we're able to get something that's a star project, like loan to total value extremely low, like 40%. So the developer is putting in 60% of their own equity, and they purchased the land with all cash last year when the price was still not that high, and foundation is also done. We're just building from ground up. So really, we're the last dollar to come in, and the most risky parts of this construction has already been done. So that's why we want to make we're starting small. So the first offering, for example, is only 250K, which is extremely small by real estate standard, and the entire loan is even only 1.5 million in total. But we want to make sure we start small and safe, and then we'll use that as a solid foundation to expand into different geographic locations, different types of assets, and even into equity.
What is that, like a stick construction project? Is that like a 4-story, 5-story stick construction?
I believe it's an 8-unit multifamily construction project. Yeah, I see that BRIKBC has requested to speak since the beginning. of the Twitter space. So I want to make sure that you get a chance to speak. All right, I see that you're connecting. And Austin, I see that someone else also has requested, so we can, have him or her up next. All right. I think you can unmute. BRIKBC. Yes.
How are you, Scarlett? You well?
Hey, how are you?
I'm well. Yeah, just based here in Brisbane, Australia. So just hearing you guys talk, fantastic conversations. Music to my ears, obviously. We are tokenizing real estate, residential real estate here in Australia. So we started. And just hearing you guys talk in terms of the challenge and so forth, it was great conversations there. I really enjoyed hearing it. But just probably on the point you were making in terms of people in crypto and obviously the trying to articulate the opportunities in terms of tokenized real estate. We actually saw crypto, and obviously it's this we're so early. I mean, obviously I think most of us would agree here that we're so early, and a lot of it has to do with education. And we saw as part of our timeline to actually have conversations with people with crypto because they understand blockchain. It's an easier conversation to have. Um, the challenging thing is basically to understand that, as we sort of articulate to people in crypto, is that you also got to park some profits away. And we see when we talk profits, obviously profits in crypto portfolios, especially over the last, sort of, well, not so much over the last few weeks, but obviously over the last 18 months in particular, some of the profits being made in crypto. So we see actually a good way for people to have a sort of diverse portfolio, park some money in property, and then obviously tokenized real estate's the ideal space because it's backed by real hard assets, as we all would agree. So again, it's that conversation that the markets aren't always going to keep rising. There's going to be troughs and bounces all around, especially in the crypto space. So it's I think it's quite shrewd to actually park some profits in real estate, but in tokenized real estate, we all know in terms of where it's going. I mean, I know in Australia, property here doubles every 10 years. So, and I'm sure in some of the markets you guys are in, you have the same situation in terms of some of the great returns. So I just wanted to sort of share that in terms of our experiences so far here in Australia. And obviously, I mean, our market is an international market in terms of who are buying our tokens. So yeah, just like to share that with you.
Yeah, we also have opportunity zones here as well, which I don't think you may have a similar structure, but our opportunity zones are really interesting. They allow us to invest into these certain census tracts, some of which happen to be in pretty expensive neighborhoods, but they're designed to promote development. And we're able to pass along opportunity zone benefits to investors inside of these areas where we have these investments, and the savings are substantial. So, firstly, if you don't pay your taxes that are owed today until December 2026. At which point you get a 10% discount when you make that investment. So, for example, if you flipped some apes or something, or you had an NFT project that did really well, you get a 10% discount payable in 2026. And then your investment into that capital asset, if it's held for 10 years, your basis steps up to the exit price in year 10. And so you effectively get that tax free as well. So, the idea of taking profits and plowing into real estate is great. If you can plow it into an opportunity zone, it's even greater.
Hey, my name's Pierre. I'm a real estate developer in Brooklyn, and also a DGen, which is how I found myself on this chat. But I kind of like keep them separate in my life, and it's like awesome to see people kind of bridging the gap. I've been sort of looking for a way to do it myself for the last 2 years or so, and what I've struggled with was just kind of trying to understand. I know we're kind of like speaking from the perspective of a GP in a real estate fund. Like, what, as a developer, how are you guys, like, are you guys treating the token holders of these projects as sort of like the LP position, or am I missing the point here? Kind of like, what, as a developer, that there's a lot of work that goes into it, right? And who's being compensated for that and how? And then after the development is done, how are you guys thinking about structuring actual management of these properties, right? Like, real estate is far from passive income. It's like a lot of people on Twitter and TikTok like to kind of like describe it as passive income, but like anyone who's in the industry understands like that is just far from true. Even when you have third party management, there's a lot that goes into it as like the actual sponsor on an ongoing basis. I just wanted to understand like for these projects what the plan is there, if there isn't kind of a more structured GPLP type split in terms of responsibilities and economics.
Yeah, so that's kind of why we choose to deal with just the construction financing or the debt aspect of it. So we actually don't manage and own a property because, as you kind of mentioned, as soon as you're managing a property, it's not really fixed passive income because it's actually very active. So after the developer finishes the project, so our relationship between us and them actually ends. So we only just come in and then purchase a loan onto our book and then tokenize it through SPV, through Reg D or Reg S in a completely legal fashion. And the resulting token now legally represents shares of ownership into this SPV, which in turn holds the project. So the investor will be receiving K1 at the end of the year.
Okay.
So that's,
So I think I missed that part. So you guys are really providing more like construction financing on the debt side. And if someone defaults, then you have to take it over. But that's like, since it's only 40% LTV, you're not, LDC, you're not really expecting that. Are these how are you guys setting the rates?
That's something that we can talk probably offline because at the end of the day, it's still, a market, right? So we try to be competitive against their other options because the developer can choose to come to us or they can go to a PE, right? So on that front, between us and the developer, it's actually pretty traditional. It's just like they're treating us as if we're just another, PE fund that they can get financing from. And between us and the investor, we try to pass on as much surplus as possible to the investor as long as we're not losing money, because we want to make sure that the unit economics actually work. Because you don't want to run a business where the more you sell, the more you lose. That could last maybe for the beginning when you're burning VC money, but hopefully none of the VC is in today's chat. But over time, we want to make sure that we can at least be running on ourselves. So
are these loans all like? And kind of just getting a little bit nitty gritty, and if it's a little too much, just let me know. But are these all personally guaranteed by these developers? Like, are you guys putting warm bodies on these loans, or are they just collateralized with the actual land? And I guess if you're coming in at the end as mezz, like the bricks that have already been put down.
Right. So we are working with usually first lien senior loans with full recourse. So in this case, there is land as collateral, and they're personally responsible. Not each and every project will have full recourse, right? But at least we'll ask for first lien senior loan position. So at least there is the piece of land that we can go after, even if default happens. And usually we work with developers with a lot of cash, and they put in a lot of their equity, so they weren't planning to default when they went into this loan with us. Yeah.
Why are you choosing construction loans versus just like traditional acquisition loans for like that's sort of, as a lender, that's like the highest risk type of real estate loan, is like they're usually variable rates, like for a reason, and there's like that's where the highest default usually happens. But like if I was like, for traditional multifamily like acquisition loans or like refis on just like cash flowing assets, like core plus stuff in really good neighborhoods, like that stuff rarely defaults, at least in New York, if it's not like way over levered. But why are you choosing this like higher, like, I mean, they're higher yield but higher risk loans right now versus like going like the safest route?
Yeah, absolutely. So there's definitely a trade-off. So here we chose construction loan because of the higher yields and higher rates, and because we have on our team members who have actually extensively worked specifically in this vertical. So they are on average or ex ante very high risk, right, to an average person. But if you happen to know the right person, be in the right network, and have worked on these for a long time, for many years, then to you actually have a comparative advantage judging which is the more safe one compared to others. So this is, things are all relative, right? After all, you're trying to essentially find some kind of niche market where you can arbitrage while others can't. So that's why we started with this vertical, because we have a relatively better pair of eyes to judge, and it's on average riskier to any other person, but slightly less risky actually for us.
Yeah, we are actually treating them like LPs to go back to your original question. So the sponsors stay on and are actually running these deals, and we're tokenizing these deals in the form of the NFT with these sponsors that we're hand selecting, underwriting all of these assets when they come on chain. And at this point, I'm speaking about third-party sponsors. I'm not speaking about our assets that we're bringing on chain. And in that case, we're going to do a full diligence on the entire deal and underwrite it from an investment banking perspective before we tokenize that for LP consumption.
That makes sense. So it's sort of and like versus just, I mean, there's products out there, and this is like just sort of thinking out loud, and this might be very obvious to you, but I just want to make sure it's articulated. But versus like there's things out there like Fundrise and like products that are obviously like accessible with small checks to average retail investors in real estate. It is not relative to most types of private equity. Real estate is probably the easiest for your average investor to access with low ticket sizes, just because of how much infrastructure has been built around for accredited investors, at least in the space. Like how are you guys thinking about that side of things? And excuse me if I joined a little too late and you covered this. And I ask specifically because I'm a part of this one DAO that is a land DAO, and they've kind of been, their approach was actually like keeping everything very, very according to SEC regulation. Like everyone had to be qualified purchasers and accredited investors, lots of paperwork for that. And ultimately, like what they were trying to achieve was just a more distributed like governance protocol around decision making as a sponsor, and it wasn't really about access to capital, because that's where things get tricky with regulators. And my like ask is sort of like, if you're doing it that way, what is like the major benefit what is the major benefit that you're trying to achieve versus just using something like Fundrise? Like what does the tokenization actually achieve here?
That's a great question. So firstly, we tackled the regulations head on. We just decided out of the gate we wanted to maximize access. And so that means Reg A, Reg A plus, Reg D, Reg CF offerings that are discrete buckets to allow maximum subscription from people who are both accredited and unaccredited investors in a compliant way. But what's different about us is all of these other platforms are simply tokenizing this asset. And the idea is that through the magic of tokenizing it, it's some sort of like weird economic transubstantiation where they turn like water and wine into like the body and blood of Christ. They think that it miraculously now becomes liquid. And that frankly is not the case. What makes the asset liquid, what makes the secondary actually robust is data. And all of these platforms are dealing with data that is not on chain, that is not immutable, that's not totally transparent, that doesn't live directly in the asset like ours does inside of the RE NFT that we designed, so that every single data point is there. So that when you pull those construction permits, when you go and you get the loan from Robinland, when you service that loan, all of these are data points. And they're data points that don't exist and therefore don't compel any type of a transaction in the secondary.
So it's kind of like real-time AppFolio, like for like the way like my management. That's cool.
And on top of that, to your AppFolio point, when it's time to release those K1s to those LPs, all of this stuff is automated. When your LPs say, hey, what's going on with 123 Main Street? Am I making money on it? Well, they're not calling you, they're not emailing you. It's on chain, it's there, right? So we create the UX so they hit a button and they have that report. They don't have to email you. They don't have to trust you. It's all on chain.
Right. That makes a lot of sense. Where are you based?
So we have our office in Hoboken, New Jersey, and we operate New York, New Jersey, and Connecticut, Massachusetts, where I hold licenses. So we have deals, in New York City. We have deals in New Jersey. We have deals in the Opportunity Zone. So a lot of really good projects, including, we have a project that's going to be coming onto the platform in the future, which is 1 million square feet in Hoboken, which is a $1 billion total development value, which is, these are major assets in core markets that we're frankly very proud to be bringing online.
Yeah, that's awesome. I'm based in Park Slope. I'm in Brooklyn, so anyone who's in the New York area on this, just shoot me a DM. I'd love to grab coffee. I gotta eat some late dinner right now, but I'm gonna hop off. It's really fucking awesome hearing about this. I'd love to meet up with anyone and just rap on this stuff for a little because it's right up my alley.
Yeah, we're based in New York. We should meet.
Yeah, I just DM'd you.
DM
and
you.
John,
Yeah,
I'll DM you too, John. See you guys.
Yeah.
Anyone else on this thread who wants to link up, shoot me a DM. Peace.
Yep, great.
Thanks, guys.
I think so. Just on the previous topic, Pierre asked a really good question, which is why tokenization, why blockchain? Why don't you just use Fundrise? So to me, this is because we're trying to unlock liquidity in crypto that are otherwise locked towards the $20 trillion of USM2. It's might be counterintuitive, but once a US dollar gets into crypto and becomes a USDC, the probability of it going out is actually very low. Like for most of the crypto degen that I've talked about, they wouldn't very often on-ramp and off-ramp. Like their USDC holdings stay USDC because of various reasons, like tax or legal, other kinds of implications. That's why there is actually a pot of liquidity that's basically out there that the real economy wouldn't be able to access because of this translation issue. And by building a technology that allows USDC to flow into real estate, we open up that gate. And another reason is within crypto, there are technologies that allow for really low cost of capital. For example, Maker is creating its own stablecoin DAI. So it's essentially acting as if it's a central bank trying to mint out a new currency. And in order to do that, they need real asset to back it. So essentially, if we can become a asset supplier or underwriter for Maker, we can access that extremely low cost of capital because they can go as low as they want to because there's no cost of minting that money out. And then by having that source, we can then become very competitive when we lend to developers on the other side of the market. So that essentially is providing better capital to solve the construction crisis that we all have in the US right now, providing more houses for people to live in. And this benefits both worlds. People have more houses on the one hand with lower costs. On the other hand, current cryptocurrency providers have better assets to back those stablecoin. So that's to me why we need blockchain for real estate and vice versa. And I see that James wanted to speak. Wanted to give you a chance.
Hey, thanks for having me. I'm James McCall. I'm, based in Idaho. I've been in a few DAOs. I've been in LexDAO. I guess I'm a lawyer that I don't practice, but been kind of around the space. LexDAO helped kind of work a little bit with Maker on looking through some of their real world assets on farmlands and stuff like that. So definitely been trying to figure out how this all fits together in the space with DAOs and real property and how basically DAOs can own real property is kind of the white whale I've been chasing for a while, I guess. But one of the issues we're running into, and it sounds like the RE NFT kind of starts to paper over this, or is getting the data that ties to real estate and makes it where DAOs can kind of manage this property in a permissionless manner. And I guess that's really where I'm kind of excited to see is how do people, like when you have an NFT, like an NFT is just an NFT, just points out to other data. Like how do people look at transferring these assets out of these structures, and what impact does that have? Do you burn the NFT? How do you kind of manage that data struct when you're moving stuff around, I guess?
Yeah, I mean, for us with the RNFT, we're dealing with our custodian, right? Transfer agents, like we're in a full ecosystem where we're holding on to that asset and safeguarding it. So once we hold that asset and safeguard it, you're trading against that asset that's held, and then we're updating the cap table of that RENFT to represent the transfer of ownership across these different transactions. And so one of our focuses is, even though the DeFi ethos is sort of like, oh, not your keys, not your crypto, we get that. But if you have $100 million of assets in your wallet, you're probably not going to feel super comfortable about it. And the reality of the situation is, it's not just a retail customer tool, right? It's not just a retail customer product. You need institutions to be part of the capital stack in these assets because of how the SEC has rigged the game. The SEC won't let us raise $1 billion to do a deal unless we're a public company, at which case you're going to exceed the 2,000 people. Obviously, you become a public company, and now you're just a REIT. And if you're a REIT, then you don't have the access to the individual asset with the individual tax advantages of that asset. And so these are compromises that you realize you have to make to have a healthy ecosystem with liquidity. And so then it becomes sort of like a fait complete. You're not just going to be chilling with $100 million NFT in your MetaMask wallet. Like, that's kind of a ridiculous proposition. And so we've devised this much more secure way to custody the asset, hold it, especially during season periods, especially when it's subject to a year of seasoning for SEC regulations, for example. We need to be able to hang on to that asset during that period.
Yeah, that makes sense. And to some degree, I'm kind of coming at it from the other perspective, which would be like, how can small holders, people that already own the real property, maybe it's a ranch or a farm or a commercial building, and maybe they want to own it as a family, and they use basically a DAO as the front end structure to kind of control their own cap table. And maybe I am more coming from the decentralized ethos, that it'd be really neat if people can kind of use this technology to crowd fund in their own regulated manner, and or from families and friends, or just normally how people kind of manage a lot of small property out there. Not necessarily the $2 billion shopping center, but to me, that's why we made a Tater DAO, which basically kind of layers the metadata in and allows people on Arbitrum to mint an NFT that represents a lot of data for like the reasons you say. Like, an attorney can draft a lease around it or a purchase agreement. They would know where the property is. They would be able to layer in various data feeds into the property to kind of show where it is, so that the NFT is useful from a structure of being able to like locate the property, draft legal agreements around it, and then also, like you said, layer in data. It could be financial data. It could be all kinds of things. And then the other kind of cool thing about NFTs is you can use them as like due diligence rooms, right? Like, you could token lock your NFT holders, and you could have your own private data rooms where people can look at their data, and it's off chain. So anyway, very interesting approaches, and it's exciting to see so many people coming at this from different directions, I guess.
That's precisely how we're looking at it. We're looking at it in the very same way. The NFT is token gated. It is effectively a data room with every single piece of metadata on it. It's just that we've expanded the number of structs available for us to put inside of the NFT by orders of magnitude, and then standardize that in a schema that allows, I guess your Tater DAO, I guess is what you said it was. You guys could just grab this tool, use it, and tokenize it, and then you can choose what structure that lives in. That can live inside of a DAO. That can live inside of a trust that lives inside of a DAO. You can make those decisions at your discretion, provided that they're regulatory compliant. And insofar as they are regulatory compliant, then you can then avail yourself to the secondary that's provided, and then what we describe as the tertiary, which is DeFi and lending protocols that can plug into that and provide debt or other forms of liquidity against those NFTs.
Awesome. And as an NFT, like, do you see? One thing I've been wondering is, if you have an NFT, you could basically have the legal organization that could operate around that NFT and say that, for our purposes, this NFT is going to represent, ownership, so that we can sign if the token holders sign a lease, then that's a valid lease, right? Because it's just most contracts are just digital rights. So like, as long as you're not moving property, that requires to touch the county chain of title or something, you more or less can enter in all those agreements, like you say, leases, or you can hire a property manager, or you can, maybe bundle certain other rights that just require, contracts. And I just think that's pretty exciting to be able to kind of put that stuff all together. I'd really like to see this RE NFT metadata standard. Is it on GitHub, or like, is it out there like the schema?
So we're releasing it later this year. We did a demo of it at Columbia University during NFT NYC, but we haven't released it publicly yet.
Okay, and just just to clarify there, John, that's through Balcony DAO, right? That you're doing that, the RENFT?
Correct. Balcony DAO owns the RENFT technology that we'll be making available for anybody to use.
Very cool.
Oops, I think that was a technical issue. Can people should be able to unmute themselves now. Sorry about that.
Yeah, thanks. I think it was yeah. James and I are working on Tater DAO together and have been playing. DJs here too. We've been working with Real World Assets Consortium, trying to establish this data, kind of this land classification data struct, and it sounds like you guys have something that we definitely would love to learn more about for that research. But yeah, I'm just checking out Balcony DAO right now. It's a great site, so very, very interested to learn more about these RENFTs.
Yeah, they also have the advantage of printing a hash, not just to our subnet, but also to Bitcoin. And so we view Bitcoin, frankly, as the county clerk's office of Web3. And so when you make these transactions, you can also hash them to Bitcoin, which solves some of the issues that people have around, what's the permanency and durability of this product going forward. But unlike, for example, Stacks, which is a great project, but just a different approach, ours is EVM compatible. And is built in Solidity, which opens up the field of potential developers by orders of magnitude versus, Clarity or Rust or other
Right.
technologies.
Yeah, that's good.
All right. Thanks so much for everyone. I know it's already kind of late, especially for the East Coast. So I just wanted to, really thank all of the speakers today and also everyone who just chimed in and spoke up. This is what makes this field so interesting. Like so many different approaches, so many different people trying to work with different problems and, all trying to bring real estate, real asset, and blockchain together. And I just wanted to let our official account Robinland speak at the end and wrap this event up.
All right, that was awesome. Thanks again to all of our speakers, for everyone joining tonight. Don't forget, you can sign up for our newsletter and follow our official Twitter to stay up to date and get the latest updates on Robinland. And don't forget to join our community on Discord and Telegram. Thanks, everyone.
Thanks a lot. Thanks for coming.
Thanks, guys. Have a good one. Have a good night.
You too. Take care.
Thanks, everyone.
Speak very soon.
Ciao, ciao.
Ciao, ciao.